Hello, everybody. Welcome. Hi, everyone. Welcome to Monday evening's economics revision. So my name is Subomi King. I am an economist. So I studied political economy for my undergraduate degree. I'm currently studying my master's in economics part-time because I work in the civil service in the UK as well. So what is the Monday classes? What are they going to look like? So every Monday at 8 p.m., we'll be here for about 40 minutes to go over one of the topics. The revision classes on Fridays as well with another teacher, but I will take the Monday classes. So this is a schedule. So today we're gonna talk through financial institutions. Classes, there'll be online quiz and online quiz available after every topic as well. So once we're done with this, I will share a link to the financial institutions quiz. There'll be 10 questions, each one mark each for you to attempt after we go over the topic. So financial institutions, what are we going to cover today? So we'll cover money and capital markets, types of financial institutions, functions of financial institutions and economic development. So money, what is money? Money is anything that is generally accepted as a means of payment for goods and services. So for example, you have Naira notes, coins, bank deposits in your current or savings account. And you have to note that money is the most common medium of exchange, meaning that if you want to buy something or you want to, buy, let's say, a gift for somebody or buy something from the market, the way money works is that it sets a value for these goods so that different people know how much this thing would be. So money is a part of the financial sector. And I think it's important that we note that for the rest of this topic. So functions of money. Like I said earlier, money is a medium of exchange to facilitate easy exchange of goods and services. Money also provides a common measure of value or a unit or a standard of deferred payment. And finally, it's a store of value. So there are three different functions of money, and these are the three functions. Next, why do you even want to hold money in the first place? So there are three main motives for holding money. We have the transactions motive, which means that you hold money because you want to buy things. Then there's the precautionary motive, meaning in case of an emergency, say, for example, you're sick and you need to go buy medicine, you need money to make sure that if anything ever goes wrong, you're able to take care of yourself. And then the last thing is the speculative motive. So for example, you want to invest in, let's say, property. You need money to be able to even do that. So those are the three main reasons for holding money. So remember earlier I said that money is part of the financial sector. So we're going to look at what exactly the financial sector is. So it consists of different organizations and involves the inflow of capital. So if you look at the diagram here, we have the financial sector in the center. Now it's made up of households, firms, that's companies, and governments, all of which these three, they perform economic activities. So the household will be able to lend and borrow money, firms can lend and borrow money, and government as well can do that. And the way the financial sector works is that those who have the money but don't want to use it at the moment, that's the savers, will essentially be giving money to the borrowers, those who need the money. So what exactly in the financial market? We have two different things. We have the money market and then the capital market. So I mentioned money earlier, and that's very easy to understand what the money market is, right? Now we're going to look at the capital financial markets. So whereas the money market is a financial market that, institutions can provide short-term loans for investments, the capital market is a financial market where institutions grant medium to long-term loans for investment. So think about it, the money market is short-term loans and the capital market is medium to long-term loans. Under the capital market, as you can see here, we have the stock market and the bond market. So what kind of instruments in the capital markets, what kind of instruments are used? Some of the instruments that people use in the capital markets are shares. I don't know if any of you have heard of shares before, or sometimes they're called stocks, but it's basically a portion of a limited liability company owned by an investor. So take, for example, recently MTN has issued shares to the public. That is, they want people to buy parts of the company. So when you buy a share, you're buying a portion of MTN. Another instrument that is used in the capital markets are bonds. These are, long-term financial securities that are used to source for funds. So they're issued by firms, sometimes financial institutions, or even sometimes governments. Then we have treasury certificates. These are usually issued by governments. They're financial securities which mature after a year. And it's issued through the central bank to either borrow or lend money, again, inside the capital market. And then the last thing that I would mention here are debentures. These are loans raised by a company, usually with fixed interest rates and sometimes fixed redemption rates. So a debenture holder is essentially a creditor to a company. So let's say I have a company, I want to raise money. I could raise money via bonds, or I could raise money via debentures, or I could raise money via shares. But if I raise money via shares, I'm selling parts of my company. Whereas if I raise it via debenture, it just means I get the money from you. I don't sell my company to you, but in maybe a couple years' time, I give you back the money with an interest rate that you loaned me. So what are the advantages or the functions of the capital markets? So like I said earlier, the capital markets provides medium to long-term loans to both the private and public sector for investments. Savings are mobilized in the capital markets. It encourages the growth of merchant banks, also known as investment banks. And finally, the general public can also participate in the running of the economy of the country. So now, like I said, we have the financial, sector, and under that we have the money markets and the capital markets. Now, there are different types of institutions that work in both the money markets and the capital markets. In the money market, like I said, we deal with money, short-term instruments. Under that, institutions in the money market are the central bank, the commercial banks, discount houses, finance companies, microfinance banks. Whereas in the capital market, we have things like the stock exchange market. If anybody knows what the Nigerian Stock Exchange, I might have given that away actually, but what the stock exchange market in Nigeria is called, you can type it into the chat. And here, like I said, they sell shares or stocks, as they're also known. You also have things like insurance companies as well. So I've given all, over here we talked about institutions. Now we're actually going to get into the nitty-gritty. What is a financial institution? So a financial institution is a company that is engaged in the business of dealing with financial and monetary transactions, such as deposits, loans, investments, and currency exchange. So I'm sure if I ask you, what do you think a financial institution is? You'd say a bank. And that's right, because banks are a type of financial institution. So, but financial institutions are not only banks, they encompass a broad range of business operations within the financial services. There are other types of companies that are also financial institutions. So, like I said, I know many of you would name banks as financial institutions, but we also have non-bank financial institutions. So where a bank receives deposits from the public and government, and non-banks might also receive deposits from the public. In the bank, the deposits are payable on demand, whereas in non-banks, deposits are not repayable on demand. So say, you have a bank account at Access Bank or GT Bank. You've put money in there. You go in tomorrow and you say you want your money back. That's your deposit. They have to give you your deposit back on demand. Whereas if maybe you were paying money to an insurance company to insure your car, your house, or even, there's health insurance as well, and you go back and you ask for your money, they're not going to give you your money back. You've kind of given that away. The only way you would get it is not on demand. It's essentially if, something happens and you need to make a claim against your insurance. So, like I said, we have bank financial institutions and non-bank financial institutions. So under bank financial institutions, we have the central bank. We have different types of commercial banks. We have mortgage banks, or as they used to be known, building societies. Then we have merchant banks, which are also known as investment banks nowadays, and then development banks. Whereas in the non-bank financial institutions, things that your syllabus covers are insurance companies and then pension funds. So let's look at a central bank. That is, the biggest bank in a country, essentially. When you look at the Central Bank of Nigeria, you can tell that it's, like I said, it's Central Bank of Nigeria. It's a government-owned bank. It's responsible for formulating monetary policies in the country, and it's the head of all the banks in Nigeria. So Central Bank essentially, is the head of all the GTs, the Access Banks, the First Banks, any bank you can think of operates under instructions from the central bank. Now, like I said, it's, the biggest bank in the country. There are different functions that the central bank does. So one of the things that it does is that it will issue banknotes and control the supply of money in the economy. So all the naira that you see floating around, that you have or you used to buy things, they've been issued by the central bank. They also control monetary policy by setting the bank rates. So I don't know how many of you do finance here, but there's a thing called, the bank rates and the interest rates. And that is how the central bank controls the amount of money in the economy and the amount of money that is circulating and the amount of money that, commercial banks can give out. It provides financial stability. It acts as the bank for the government because it's their own bank. And as I mentioned earlier, it acts as the bank for commercial banks. So we've talked about central banks. Let's move to commercial banks. So if you think of like the likes of GT, First Bank, Access that I've been mentioning, these are financial institutions usually established as a joint stock company with the aim of making profit. And they usually grant short and medium-term loans. So if you think about what you do at your bank or what your parents do at their banks, the number one function of a commercial bank is to accept deposits. That means that people can pay in money and the money can be kept there for, in different types of accounts. You could keep it in a savings account, a current account, demand deposits, fixed. There are different types of accounts, but you go to banks to essentially deposit your money in there. And what they do is they accept your deposits. Now, let's say you don't actually have that much money, or you're needing, you have some money, you're saving towards buying something, but you need a bit more money. You can also go to a bank for them to lend you money. So commercial banks make available loans, overdrafts, and discounts for their customers. You can actually also decide that, I have gold and have some, really important things that I don't really feel safe keeping at home. You can go to a bank and the bank will offer facilities for the safekeeping of your valuable items. They have trust services, again, to manage trust funds. So let's say you're thinking about, keeping some money aside for your children later in life. That's called a trust fund. They would be able to give you, advice on what type of accounts to do and how to store that money for your children. Next thing that they do is, agency services. They can act as agents for the customers, for you, if you want to buy or sell certain securities, like, let's say shares or bonds that I mentioned earlier. And finally, they offer advisory services to their customers. So if you have, any money related query or issue, you can go to them and they can essentially offer some advice on, what to do. Then other types of banks that I mentioned were mortgage bank, also known as building society, and then merchant banks, also known as investment banks. So a mortgage bank, sometimes commercial banks actually acts as mortgage banks. So a mortgage bank or building society is a financial institution that specializes in the provision of long-term mortgage loans for building purposes. So the best way to explain this is to think about when I said about borrowing money earlier. If you wanted to buy a house and you didn't have all let's say the house was worth 100,000 naira, but you didn't have the 100,000 naira, what you can do at a mortgage bank is go to them and say, look, I have 50,000 naira. That is half the price of the house, but I'd really like to buy this house. Can you please loan me some money to buy this house? And they would say, yes, sure, we'll loan you the money, but we need some form of collateral to ensure that you pay. Or we need to make sure that you're able to pay. And so you'd pay us back monthly. That's essentially what a mortgage is. So rather than you having to put down all the 100,000 yourself, you put down the 50,000. The bank puts down the rest of the 50,000 for you. And then every month when you earn your salary, you just pay back some of that 50,000 that they've lent you. So that is what a mortgage is. Now, the reason why mortgage banks are really important in the economy is that it actually promotes savings in the economy. Now let's look at merchant banks, or also known as investment banks. These banks typically don't deal with just everyday individuals, customers. They deal with commercial companies. They look into commercial loans and investments. So think about it as, instead of a bank for a person, they're banks for businesses. So again, almost like a commercial bank, they have their own functions, but geared towards companies. So they provide advisory services, they grant loans and advances, they accept deposits, but then more importantly is, they act as issuing houses in the capital markets. So a lot of times, if a company wants to, say, wants to distribute or sell shares on the stock exchange, because that's what typically happens. So let's say let's go back to my MTN example. We have MTN. MTN wants to, I guess, they want to raise money by getting people to buy shares in the company. So that means I would buy a part of MTN, a share or stock, however you'd like to say it. But before I can do this, right, MTN needs to go and meet their own bank and talk to their bank, which would be an investment bank, and basically ask them what is the appropriate way to do this. How do we issue these shares in the Nigerian stock exchange, that is in the capital markets? And the investment bank would basically act as the issuing house for MTN to issue their shares. I hope that's clear. And then we have insurance companies. So I mentioned insurance companies earlier. I said that what they do, well, the correct definition of an insurance company is a financial institution that provides compensation for specified loss, damage, illness, or death in return for an agreed premium. So how these work is that, let's say you want to buy a car, but you're scared of your car getting in an accident, because let's be honest, cars are very expensive. What you would do is you'd buy a car, but then you'd also buy car insurance. How car insurance works is that every month you'd pay maybe, let's say the car was worth, again, for simplicity, 100,000 naira. Every month, maybe you'd pay 5 naira to the insurance company. And what this 5 naira does is that it's you paying for your insurance, your car insurance, in case of an accident or theft of your car. What would happen is that if let's say you're in an accident in one day and your car was totaled, the insurance company will buy a new car for you most times because you've been paying that insurance against, they provide that compensation in case there was, loss or damage of your car. And it works with different things, health insurance as well. You pay a little every month so that, if there's a time where you're really sick and your hospital bill is really high, your health insurance provider will probably just pay the insurance off for you. So that's how insurance companies work. Now, what they do with the money that they collect every month is that they invest that money in the capital market. So they buy stocks, bonds, and that is how they make their own money. Is that because if you invest in stocks, if the stocks, if you buy it for one price and it increases in price, you can sell it off, make a premium on that. Or some people would pay that 5 naira every month, but actually never ever get in an accident, and so they never need to claim for their car insurance. But it's, I guess, better to be safe than sorry. So next, let's look at development banks. So there are different types of development banks, or the different development banks that exist. There's African Development Bank, there's World Bank, there are many banks, and what they do is essentially contribute to the development of sectors in the economy. So some development banks focus on, just industrialization. Some focus on agriculture. They just any sector you can think of. There are probably development banks that target that alone. So they provide medium and long-term loans for investment in these sectors, and they bring into the local economy, investable funds from international organizations. So let's say, give an example of, say, like the Bill and Melinda Gates Foundation want to work with a development bank to make sure that the poorest areas in the north, in northern Nigeria, have access to water or have access to, food. The way that they would work with the Bill and Melinda Gates Foundation is that they'll bring in these funds and work with different companies on ground to essentially provide what people in the north need. So we talked about we've talked about banks, we've talked about money, we've talked about central bank and commercial banks. And I mentioned earlier that the central bank essentially has rules for commercial banks. They're bankers' banks, right? They control how commercial banks work. Now, I haven't touched on how they do that. So how does the central bank control the amount of credit given by the commercial bank? So the first way is through the manipulation of the bank rate. So if the central bank wants to encourage commercial banks to lend more, it will reduce the bank rate. If it wants to discourage the commercial banks from lending, it will raise the bank rates. So let me talk through this. Let's say, I mentioned savings accounts as one of the accounts that you can have in a commercial bank. So if you go to GT Bank and you say, I want to open an account, I want to open a savings account, they will tell you what the interest rates for that account would be. Let's say the interest rate is 2%. That means, let's say it's 2% a year. So they tell you, if you put in 100 naira today and you leave the 100 naira for a year, they will add 2% onto that at the end of the year. Meaning if you now want to take your money out at the end of the year, instead of 100 naira, you take out 102 naira. So that is how interest rates work. And it works the other way as well. If you want to borrow money, banks don't just dash money or give away free money. If you wanted to borrow 100 naira from the bank, they'll tell you, okay, you can borrow 100 naira, but there's also an interest rate to borrow this 100 naira. I'll use the same 2%. So the interest rate is 2%, meaning if you borrow 100 naira today, you're not going to be returning 100 naira at the end of the year. You return 100 naira plus 2% of 100 naira. Now, if if the interest rate is really low, let's say today the interest rate is, I want to borrow 100 naira, the interest rate is 2%. And then let's say next week I come back and they say, actually the interest rate is 0.1%. That means when I need to pay back at the end of the year, it would be very little I would have to pay back. So I'll pay back the 100 naira, but only 0.1% in addition. And that means I would probably, instead of borrowing 100 naira, I'd probably be like, okay, let me borrow a bit more because I don't have to then pay back that much money in return. And so that's how the central bank manipulates, people, the way people borrow money or save money. So if the bank wants to, stop banks from lending, it would basically say that, let's make the interest rates really, really high, because if the interest rate was 100%, nobody's going to want to borrow 100 naira if they know at the end of the year they now have to return 200 naira. But if they know that, if they put the money in the bank, 100 naira today, and they can save and they get 100% interest rates on top of that, then they money economy. Another way they do this is via open market operations. So the central bank will sell securities like bonds on the open market to reduce the amount of reserves the commercial banks have, and also to limit their ability to commercial banks to basically increase the cash reserves of commercial banks. So the way this works is, everybody, when the government says they want to do open market operations, they want to sell bonds on the market. Everybody wants to own a government bond because a lot of times, it's a great way to invest. That includes commercial banks as well. Commercial banks will buy government bonds. But, so they would buy government bonds, right? That's if there's government bonds available. But if there are no government bonds available, then, like I said, there'll be more money for commercial banks to lend out. Another way that central banks control the amount of credit given by commercial banks is through special deposits. So they could just, central bank can be like, all commercial banks, so every GT, every Access Bank, every bank in Nigeria has to make a special deposit into the central bank account. That means that, let's say I was GT Bank and I had 5 million in, money, 5 million cash sitting in my account. But central bank says that, you have to deposit at least 3 million. That means I now would only have 2 million in my account. So before, when I had 5 million, I could give out 5 million in loans. Now I can only give out 2 million in loans. So that means they've restricted the amount of, money that me as a commercial bank can give out. That is, they're restricting the amount of credit given by commercial banks. And then the last thing I have here is by manipulating the cash minimum reserve ratio or the liquidity ratio. So let's say when central banks wants to discourage lending by commercial banks, they will raise the cash ratio. On the other hand, when they want to discourage lending, they would reduce the cash ratio. So financial institutions and economic development. Financial institutions. Let's look at how they actually help economic development in a country. But to do that, we need to understand what economic development is. So when we think of economic development, the best way to define it is that it's an increase in the country's wealth and the standard of living. The process where simple low-income national economies are transformed into modern industrial economies. So when we can think of where, the poorest people in the economy now have better lives, there's more money for them, more food, the standard of living is essentially better for them, then we can say that an economy is developing. How do these institutions, so for example, commercial bank, the central bank, development bank, all these banks, and also the non-bank financial institutions that we've discussed, how do they aid economic development? How do they essentially contribute to economic growth? So these are some of the things that they do. They invest directly in the productive sectors of the economy. They facilitate international trade. They provide loans. They give financial, technical, and management advice to their customers. And they do a whole bunch of different things. One of the things I have here is they help in creating employment. So the more banks that they are, the more people they need to work at the banks. Another way, so for example, I mentioned development banks earlier. They provide infrastructure as part of their corporate social responsibility. So, some banks, not even just development banks, some commercial banks go back and give back to their communities as well. They say they want to different buildings, create farms for people in different areas of Nigeria. And those are just some of the ways that they help with economic development. So I hope that has been, really informative. If you want to review some of this material again, you can go to simbibot.com. For those of you that do biology, I know that the biology teacher mentioned this website earlier on. And if you go there, they have notes for all the different topics in economics. So you can go there and, read again, test yourselves. But if you feel like, you understood what I've taught today, even if you feel like you haven't, you might actually want to take this test that I have created first. I will send the link into the chat box. It has, like I mentioned earlier, after every topic I teach, there would be a quiz for you to take. It would be 10 questions. It's multiple choice. All you need to just put in the whether A, B, C, or D, just click on it, and it would automatically tell you when you've completed all 10, whether you've gotten it right or not. I will send the link to the test into the chat box now. One second, sorry. Okay, so I've put the link inside the chat box, and if you click on it now, it will take you to the test. Please put your name in and just answer the test, and just to test your knowledge, and it will let me know how useful or helpful this has been, this class has been. I think there's a hand up, I'm so sorry. Love Day.
Yeah. I have a little question to ask based on the insurance company. My question states, in case of inflation, yes, in the case of inflation, you insured your car, you bought the car, let me use the car as you use it in example. You bought a car at the rate of 5 naira. Okay. You bought a car at the rate of 5 naira. So in the time of theft or accident, there is an inflation, and the car now. Hello, can you get me? Hello?
Yeah, I can hear you. You're just breaking up.
Are you with me, man? And there is an inflation. You bought a car at the rate of 5 naira. So during the time of theft or accident, and there is an inflation, so the car now costs 20 naira or 15 naira. What stands to be the gain of the insurance company in that kind of situation? That's my question, ma'am.
So I guess it would depend on the insurance companies, and I know that they have a way to mitigate some of these things. Sometimes, depending on what type of insurance you buy, sometimes they would tell you that they would only give you a set amount, so they may not cover everything. Obviously, because of inflation, they may only cover part of it, or I guess sometimes that's something that they've also modeled, because you don't just start up an insurance company and be willing to just give money and out anyhow. You would also look at different scenarios, right? So sometimes they've already considered all of this in how much it is that they ask you to pay back. They ask you to pay every month. I hope that's clear. Hello?
All right, thank you. Very clear. Thank you very much.
No problem. Are there any more questions?
No, I'm good to go with this now.
Yes. So, like I said, everyone, please look at the chat box for those Zoom. Click on the link I sent. It will take you to the quiz for today's, revision. It's only to help yourself. The more you go about, and it's all from past question papers, or WAEC past question papers on this topic alone. 10 questions, multiple choice, test your knowledge, see how much you've learned from this revision class. And it would help you, because the more past question papers you do, the more prepared you would be for your exams. Thank you, everybody. I think if there are no more questions, we're done for today. I hope to see all of you back here again next Monday evening at 8 p.m. Please, tell your friends, tell your classmates who are doing economics that they should come and learn, come revise. We want as many people to pass their WAEC exams. So, and I'd like for it to be very interactive. So if you have any questions on the topic of the day, make sure you speak to me. Just raise your hand, type it in the chat if you're too scared to. Thank you, everybody. See you next Monday. Bye-bye.
Thank you, Ms. Subomi, for the class. We really appreciate that. See you next week, Monday. Bye.